Welcome back, everyone. The final market-moving event of last week was the October employment report. The U.S. economy created 151,000 jobs, more than double what economists expected, and the unemployment rate held steady at 9.6%. Mike Larson is back to give us his take on the report's implications for the economy and the markets. And we're happy to welcome back John Browne, the senior market strategist at Euro Pacific Capital. John, I want to start with you. What was your take on the jobs report?
Well, the headline is really, it's good, it's positive, but it's not really the whole picture. The underlying picture is very bad. I mean, they took off 290,000 people roughly that came off the employment register because they're long-time unemployed, so they fell off. So basically, you, instead of having an increase of 158,000, you've actually got a decrease of 100,000. The assumption that there were 61,000 new jobs created by small business was not supported by the other bureaus or by small business. It's just an assumption, all positive thinking. Basically, we're substituting full-time jobs with part-time jobs, and an economy can't grow like that. And we're fiddling with the figures by not including the real unemployed. I mean, basically, we lost 1.1 million jobs in the last 5 months. And so 159,000 doesn't look that great, particularly when it's not real, a net figure. It's a distorted figure.
Mike, you agree? A lot of optimism built into this report?
Well, sure. I think the headline number did look positive, but for some of the reasons John discussed, there may be a little bit of fudging going on there. But more importantly to me is what's happening with real unemployment. If you add in all the workers who can't find jobs and have just decided to give up basically looking, and the Americans who want full-time work but can only get part-time work, these are what you call discouraged workers. The real unemployment rate, when everyone's included in the pool, is 17%. So that's really a staggering number, and it looks much worse than the number you see on the headline. So I think the jobs market, the employment market in the U.S. is in sort of a long-term period of malaise, where you're going to see companies not hiring aggressively. You're going to see job growth much lower than it should be, or than the administration wants it to be, and that means you're going to have a problem going forward for things like consumer spending.
Well, we did still see, obviously, some improvement here, despite how you want to look at the numbers. Was it due to the government's policies or perhaps in spite of them?
Well, as I said, I don't believe it really was improvement. It's cooking the books in a way.
Right.
I think in spite of the government. I mean, take, for example, quantitative easing. Basically, quantitative easing means a devaluation of the US dollar, which against a proper measure rather than against other depreciating currencies of 20%. If you take the average of gold and silver, which is real money, it's depreciated by 35% this year in the first 10 months. That's a 35% tax on every single holder of US dollars. Totally regressive because the poor suffer more than the rich. So are they going to go out and buy? You've also got the threat of, well, the reality of massive regulation, which discourages small businesses from taking off and employing, even worse, and of course the great uncertainty. So I think quantitative easing is actually killing the economy, not increasing job opportunities, and the uncertainty and the high tax regime is also helping to destroy jobs, not create them.
Mike, you heard John's take on that. Where do you stand? And the government's policies here, if we are going to see improvements despite this October report, is it going to be because of the government's policies or in spite of them?
Sure, I'd have to agree that it's in spite of government policies and in spite of what the Fed's doing. Because again, the Fed can print money, but it can't print jobs. The money that it's creating is it's flowing to economies that have better job growth, that have better real estate markets, that have better economic growth, basically better opportunities. Investors send their money where it's going to be treated best. They're not really investing in the United States. They're not really investing in U.S. jobs. And another part of it, besides the financial part of it, is what's going on the regulatory front. Washington really, nobody knows what's going to come out of Washington in terms of new regulation and new laws. Businesses are concerned about rising health care costs as a result of health care reform. They don't know if their tax burden is going to be higher. So there's a lot of regulatory and political reasons why, if you're the CEO of a business, despite cheap money that may be available, you're not inclined to invest here in the U.S. You're inclined to do it overseas. And that means that's where you're going to build your new factories, that's where you're going to create your new jobs, and that's what's going to have a negative impact here at home.
Are we going to see any improvement, John?
I don't think for a long term, because it's a long-term problem. It's a structural problem, basically, political, and monetary. The structural problem, we've got innovation, we've got productivity increases, technological and process innovation and computers, which is a long-term destruction of certain types of jobs. And the political thing, we've allowed to stop the spread of communism after the Second World War, we've allowed all countries in the world free access to the United States economy, many of them voting against us consistently in the United Nations and causing us trouble all over the world. Massive entitlements, which of course robs the private sector of tax and spends the thing, and big government doing the same sort of thing, boosting employment in the public sector with lavish pay scales, lavish pensions, which the private sector then has to start to compete with, and therefore each job gets more and more reserved because it's so expensive, even in the private sector. And the world policeman is draining America. Monetarily, as I've said, I think the quantitative easing and all this stuff is actually destroying jobs, not creating it. And as Mike said, I think you see, take an investor, say $100,000 I've got, maybe I think now of putting it in emerging markets. I'm not financing growth and industry in America, I'm financing it abroad by buying yuan and investing in China, our competitor.
John speaks of major global problems affecting our unemployment here. Mike, will there be any improvements?
Well, again, I think we have a real split here. We have the winners versus the sinners. The winners are the emerging market economies and the other economies outside of the United States that are doing very well. Again, strong growth, good, solid job market job creation, and solid real estate markets. They're attracting the inflows. Those are the winners. And then you have the so-called developed economies like the US, like the UK, like Japan, and so on, that are keeping interest rates very low, but they're having a hard time getting any benefit from that. All that new money that they're creating is just flowing overseas. They're the sinners. They don't have the growth. They have higher debt loads. And I think that ultimately is going to result in a real split. You'll have the sinning economies grow weakly with not really much improvement on the job front, whereas the winners will continue to pull ahead in this global economic race.
All right, John Browne, thank you for your time.
Thank you, Jamie.
And Mike Larson, thank you.
Hey, great, glad to do it.
So we have discussed the large-scale implications of the three major events that have shaped the economy and the markets in the month of November. But in order to give you specific advice for making money in this new investing environment, our producer, Jen Amos, talked to all of the Weiss Research editors. She's here with their ideas for playing the markets. Hello, Jen.
Hello, Jamie.
What are the editors saying?
Well, as a rule, whenever you see the kind of major changes in the political climate or economic policy that we've seen over the past week or so, it creates huge opportunities for smart investors. Our editors are helping their subscribers take advantage of several of those opportunities. So for this Picks and Pans segment, I really wanted to focus on their buy recommendations. So I guess it's really more of a picks and picks this week.
Okay. What is the number one pick the editors are highlighting?
Both Larry Edelson and Sean Broderick are getting a major buy signal in crude oil. The Federal Reserve's decision to pump more money into the financial system has pushed the dollar even lower. And as it goes down, assets priced in dollars, such as oil, go up. In addition, a Republican-controlled House of Representatives might create a friendlier climate for energy companies. So Sean and Larry think that the recent surge in oil prices is going to continue. And Sean even said that he expects crude oil to hit $100 a barrel.
Okay, so how specifically would they recommend playing that trade?
Aside from just buying crude futures, there are several ETFs that would allow you to take advantage of higher oil prices. The most straightforward might be the ProShares Ultra DJ UBS Crude Oil Fund, ticker symbol UCO. It's supposed to give you double the returns of a sub-index that tracks crude prices. Larry recommended the ETF to subscribers in his Resource Windfall Trader service, along with the Energy Select Sector SPDR, ticker symbol XLE. That fund holds a basket of energy stocks, and as you might guess, its top holdings are some of the biggest names in the industry, ExxonMobil and Chevron among them. There are a bunch of similar funds, including one that Sean recommends to his subscribers in Red Hot Commodity ETF, the SPDR S&P Oil and Gas Exploration and Production ETF, ticker symbol XOP.
Jen, are there any specific companies in the sector that either Sean or Larry recommended?
Sean does have a couple energy companies he likes. One is a giant in the industry, ConocoPhillips, ticker symbol COP. The other one you may not have heard of, Talisman Energy, ticker symbol TLM. It's a Canadian upstream oil and gas company, but it also has interests in the US, UK, Scandinavia, and Southeast Asia. Jamie, I just want to throw in one pan here in the energy sector. Tony Sagami thinks that government subsidies to green energy initiatives will dry up under Republican House control. So he's telling investors to avoid alternative energy plays, such as First Solar, ticker symbol FSL.
Jen, what about the election's impact on stocks outside the energy sector?
Well, Tony's picks are actually in the healthcare industry. Of course, we don't know how far Congress will go towards repealing President Obama's healthcare bill. But it's a good bet that there will be some significant changes. And insurers such as United Health Group and WellPoint now have a lot more friends in Washington than they did before Election Day. Other investors are obviously thinking along the same lines. The S&P 500 Healthcare Index has been rising all month.
All right, Jen Amos, thank you.
Thank you, Jamie.
That does it for this edition of Money and Markets. Tune in next week for a preview of the holiday shopping season. We'll tell you why consumer spending is so important to the health of the economy and interpret the signals we're getting from the retail sector. As always, if you have questions for any of our guests or suggestions for topics that you'd like us to cover, please email us at weissmoneynetwork@weissinc.com. I'm Jamie Holmes, and now, Martin Weiss.
Thank you, Jamie. I want to throw a different light on these discussions. So let me share with you a personal life experience from many years ago when I lived in Brazil. That's when I experienced hyperinflation, and I'll never forget the lessons I learned. As a youngster, I saw their paper currency go to dust, then be replaced with a new paper currency that also went to dust. It was largely because of runaway inflation that Brazil's democratic government collapsed and a harsh military dictatorship came to power. We lived in Piracicaba, an industrial town in the interior of the state of São Paulo. And one day I was in biology class and we suddenly heard a great rumble. We looked outside and we saw a disastrous collapse of another kind, a skyscraper crumbling before our very eyes. What happened was that the price of cement had gone through the roof. So the builder mixed too much sand into the concrete. In effect, inflation caused that disaster, and it also caused many more. Everywhere in Brazil, inflation and economic decay pervaded our daily lives. So I've seen what inflation can do to a country, but I have never seen anything quite like what we're experiencing today right here in the United States. The U.S. is different from Brazil because the United States is the world's leading economic power. It's the issuer of the world's reserve currency. It's the center around which all other financial markets still revolve. But being a world power is a double-edged sword. It gives the U.S. the cover to prolong its day of reckoning far longer than any other country, but it also gives the U.S. the tools to dig itself into a deeper hole than almost any other major country. Last week, the Fed announced $600 billion in new money printing. And this Fed money printing is a perfect illustration of what I'm talking about. I think what's so surprising about it is not just the fact that the Fed's madly running the printing presses, but also the fact that so many otherwise smart people are actually accepting the Fed's madness. Look, in virtually every textbook, in nearly every economic course in the United States, this money printing has been clearly defined as a financial blunder. It's always been defined that way. I would say it's even a financial crime. And this crime is to take us on a dizzying roller coaster ride that swings from inflation to deflation, then to inflation again, that swings from a bubble to a bust and then another bubble again. I personally hope that this roller coaster is going to end soon. And I certainly don't expect it to reach the extremes that I saw in Brazil many years ago. But the danger is always present, and the consequences unpredictable. It's only a small minority of savvy investors who will be prepared, and I'm confident that you'll be among them. This is Martin Weiss with Money and Markets. We'll see you here again next week at the same time and place.